You mentioned that one of the big things that your team has to focus on is compliance and regulation. How much does that hamper your ability to innovate, grow, and be agile and scale quickly?
It really limits your ability to say, this is what I want to do. I'm going to go do that. There are large amounts of rules and regulations in place that are required, as well as a large of knowledge set that you need to personally become comfortable with in order to try to be innovative. So there are possibilities for innovation and speeding up the process and improving lending, both at a risk and a user experience level. But I think there is a requirement for you to understand the laws of what you're getting into before you start making those changes. So it takes some time and it takes knowledge of the law in order to make your case. But there's definitely a much, much harsher penalty for the growing pains that startups typically go through.
Well, Jason, thanks for coming on the show. Excited to have you.
Thank you for having me.
What, like 5 years or something like that?
So yeah, one of my co-founders and myself, I was explaining to my wife when I was on the podcast, when I was going to join the podcast, that we met when this was just in the idea stage in a hotel in Gramercy, given your previous experience at Lenda. So
Yeah.
great to
So
be here.
talk to me about Button Finance and like the journey that it's gone from just an idea meeting at a hotel with strangers to talk about ideas to where it is today, and just like clue people in as to what Button Finance is doing.
Yeah. So Button Finance is a FinTech originator. And in 2019, when I founded the company, the thesis was, let's create a mortgage product that can comprehensively understand borrower risk and give them a loan based off of the risk of the borrower. Um, and while that sounds like every mortgage does that, it's typically not how mortgages have been made historically. Historically, mortgages have been made, do these boxes get checked? If so, the lender considers the loan to be no risk, um, and then makes the loan. And if it is a risky loan, those loans are typically backed by the US government. Um, so prior to Button Finance, I worked at a company called PRIQ, and we were vendors to large unsecured consumer lenders such as SoFi, Lending Club, Prosper, Freedom Debt Relief, Upstart. And what I saw there were good quality borrowers getting loans at a 13+% interest rate, anywhere between 8% and 36%. But the weighted average was 13%. And all of these borrowers or individuals or homeowners who had no access to use their home to borrow money. And from a lender's perspective, a borrower who has collateral is significantly less risky than a borrower who is unsecured. So what the thesis was, let me go and give an individual who already has a mortgage, who cannot use their existing mortgage lender to take more money out of their property, and give them a second lien, a home equity loan that is inherently much riskier than the first lien, um, at an interest rate that may be, instead of 13%, we may charge them 6% or 5%, which, while now is an excellent interest rate where we are today, at the time, mortgage rates were at 2 to 3%, remarkably low. So this was a another investment opportunity for capital providers such as hedge funds, banks, credit unions, while simultaneously giving this borrower an option that is significantly better than 13% Lending Club, 20% credit card, or any other option out there. 2020
So
happened.
talk to me. Oh,
Yeah,
go
no,
ahead.
it's a little long, but 2020 happened, and we went from every investor that I had previously known in my career knocking on our doors to try to get access to this higher yielding mortgage product, to investors having no interest in any sort of risky loan product because of COVID. March of 2020, risk was off the table. We laid low, built out the product, built technology, built a team. In 2021, we raised $2 million of seed round from a large hedge fund, Hilding Capital, and the world was much more comfortable with the future of itself and COVID and what that had to bring, and we started lending. Uh, we got off to a great start, and then the market went completely uh, in a different direction. So we went from being an option for borrowers who were looking to take out money and they were already limited for one reason or another to the only option for borrowers, because what was once an environment where if you had equity available in your home, you would call Chase or whoever you had your first mortgage with and say, "Hey, I owe you 300,000. Let's make that 400,000. Give me a brand new mortgage. It's same maturity, just refinance me." Half the time, that same guy would have a lower interest rate than previously, just because markets were perpetually going to lower interest rates. And in the end of 2021 and throughout 2022, that became no longer an economically viable option for borrowers. So what happened was anybody who had a 2-3% mortgage was holding on to that for dear life, would never refinance that, so they would come to someone like myself. The long-winded answer, but and here we
No,
are.
it's a helpful to frame the full journey because I think that often we see the end result and we see where the company is today, but kind of that winding road. I mean, there are a lot of decisions that go into those, a lot of macro environment factors that happened that shaped that journey too. So one of the first things I want to go all the way back to the beginning of the story and ask you, you were at PRIQ, which specifically does alternative lending, and you identified that there was this gap in terms of funds not being available due to poor and overly simplistic credit boxes and credit profiles, just not really looking at the underlying risk of the user. So the question I have for you is, what led you to say, let me make a company out of this versus let me work with my existing employer and build a new, product line or a new aspect inside of my existing company and launching that way? Like, where was it that this needs to be a product and I want to go try and do this entrepreneurial thing rather than let me try to do this internally in the safety of my current employer?
So, to get down to the details, peer IQ is more tangential to lending than actually boots on the ground lending. Um, that being said, Ram Alawalia, who is CEO of peer IQ, I had a lot of respect for both as a person and everything he had done at peer IQ, from capital raising, running the company. I absolutely did go to him, not to work within peer IQ because it really did not make sense, especially at that time. Um, but more just for advisory on something that was completely new to me. Um, so what happened was I had previously, before I worked at Pure IQ, I was a mortgage trader. Before that, I was an investment banker, but I was a mortgage trader. And many of the previous clients that I used to work with were, as I mentioned before, looking for other ways to put money to work in sometimes more creative, but in higher yielding options. And that was what clicked for me. On one hand was Pure IQ, 13% borrowers, 13.5 weighted average coupon. 60% of these people were homeowners. On the other hand, were investors that said, um, I've traded my whole career trading bonds. These bonds don't no longer exist. All of the, you know, funky, leveraged bonds that existed prior to 2008, they were essentially uh, written down. The market was significantly smaller than it had previously been, looking for creative ways to put money to work. And how did I actually say I want to start a company? I I I did never thought I would. So I really
There's
never
a certain
thought.
amount of craziness that goes into being an entrepreneur.
Yeah, it was conversation with my family, uh, wife, and funnily enough, I said, "All right, I'm not going to make any money for a year, and then like we'll reassess. Like, is this really, you know, I'm at the point in my life where I can take this chance?" And then 4 or 5 months later, COVID happened. So I said that year timeline is going to have to be kicked out, unfortunately. So, but it was a combination of having a number of years of my career experience working as an investment banker. I was at Jefferies. I worked at Amherst Pierpont trading mortgage-backed securities, had a number of other jobs. So I had a decent amount of experience at corporate and uh, companies that had protocols, hierarchies, uh, bureaucracies, and positive ways. Then I worked for someone named Laurel Toby, who was a VC family office, um, looking at startups, talking to startups. Ultimately, went to one of her portfolio companies, PRIQ, and to be quite honest, it became a lot less scary once I worked at the startup. It did not seem nearly as hard to get to like a Series A stage, Series B from like startups I had spoken to, then it's a lot scarier when you're working at Jefferies and you're like, how does somebody go from starting a company to here? So,
Has your perspective shifted at all since working at the PRIQ and thinking, okay, I see the path to get to Series A, Series B now, since I have this exposure, versus now you've been doing this for 3, 4 years. Does that kind of perspective still align with how you view the market and view Button, or has it shifted and changed at all?
um, it is, I mean, a lot of startup founders as well. It is hard to be, I would say, confident, um, not in myself or in the company. It just, maybe this is more of an East Coast thing. Um, I've always personally just felt like I'm also at the whim of the market, so you have to both get lucky and do a good job. Um, and we're firing on all cylinders right now. We're growing significantly, um, but the VC market is softer than when it was in 2021, and people were raising on 100x revenue multiples at early stages. So I would say it's not something I think about as much as I think about just making sure we grow the business, are accurate with our, as a lender, we have to be very accurate. We can't make mistakes. Um, our processes have as little errors as possible so that our loans are, you know, performing, borrowers are happy, regulators are happy. That's really what I spend most of my time on right now. So, and if we do that well, my thought is the money will come. And it
I like
has.
what you said about, yeah, I like what you said about there is a certain degree of luck and just at the mercy of the markets. You mentioned the VC market is definitely softer, right? There's just less capital. We're not in the zero interest rate environment anymore. LPs are looking for better returns since you can get decent returns now with Fed funds
Yep.
or other areas. So or with bonds. What what has that been like for you as a founder, kind of going through some of the most changing landscapes on the mortgage side in the past 12, 18 months or so? I mean, we've seen a massive shift in rising interest rates and how that directly affects mortgages. And then also with the VC, right? The VC market was one of the frothiest it's ever been in 2021. And now it's the coolest it's been in a decade. So, how has that affected your journey? And then also, how do you adapt to things beyond your control?
So it's a good question. And um, I would say the first thing that happened to me was COVID. So it was really kind of a punch in the face right out the gate. Um, I was not working.
Quick question. Quick question. So, like, was that like, oh, fuck, what am I doing? Like, the world is ending and I just started this big, scary thing and not getting paid? Or was it just like you kind of rolled with the punches?
I was more worried about the pressure from my wife to get a job because like there were hedge funds that we had term sheets with in March of 2020, and they were interested in working with us. One of them doesn't even exist anymore. So what happened was the capital that is required to be a lender disappeared overnight because everything I just talked about that was appealing about Button Finance was no longer required to come to someone like Button Finance. All those bonds were trading so cheap that there was like fire sales throughout the market. But quick punch in the face. But I've been around. I had a stock portfolio in 2001 during the internet bubble. I was in high school. My first job um, was at Jeffries. I worked at Lehman Brothers. So Jeffries 2007. I have. It's not the first time in my career where I've seen the world go to hell in a handbasket. Um, and I would say, uh, I think that definitely made me more realistic on one that is, things go down and then they come back up, but also, um, the world is not over and it's just continue to do a good job, build your product, maybe adapt slightly with regards to uh, strategy, but it definitely helped that I was, at Jeffries and, I made it through most layoffs, but I got let go on the third round of layoffs after Bear Stearns had disappeared a few months before Lehman Brothers disappeared. Um, you know, the the vast majority of people that I had known professionally were having lunch at, you know, Thursday at noon because nobody had a job. So I've been there before. Um, and then thankfully my daughter was born in December. So it made me be able of 2022. Um, it made me be able to put things in perspective when, you know, we haven't had a market collapse or anything of that nature, but it definitely, uh, the small issues that would have caused me to lose a lot of sleep. Like I said, you know what, you know, it's not the most important thing in life, but it's definitely been a wild ride, and COVID wasn't the end of it. Um, new new ways of working for many people. Not everyone adjusted to remote, uh, but it was a good uh, a good time to start a company in many ways. And, that was one of the things that I read is just, hey, Uber started on the back of the financial crisis, right? Like there's a lot of companies that, started when things are rough. And then once they start to pick up speed, hopefully that's the same, the tailwinds of the macro economic environment.
Yeah, there's definitely a certain amount of culling that happens
Hmm.
of those with weak hands get flushed out, or those who are looking for an out take that out and say, "Oh well, the macro environment completely changed, and I'm done." Um, you touched on the early stages of founding the company and your relationship with your wife. We also talked a little bit before we started recording about your relationship with your co-founder. Where do you see the roles of wife, spouse, co-founder, these kind of core relationships that you spend day in, day out so much time with? How do they come into play? How do you lean on them or ask for support from them when building a company in the crazy world that is entrepreneurship?
I mean, I think it's more of a life thing too, right? It's very hard to go through life if you can't rely on other people to help you emotionally and however other way you need support. So, um, having it's very difficult to start a company yourself and, be CEO, CFO, CO. It's probably close to impossible. There's very few companies that have done that successfully, and it's always remarkable stories. But Button Finance is not one of those companies, and um, both co-founders as well as other employees here, we have to rely on each other because, like I said, not one person can do everything. Um, so, one of the uh, issues I would say that we did see is, well, Button Finance is a fintech company and a fintech lender. You know, there is a large mortgage market that has been around for a very long time. So when looking to hire people and find people to add to the team, not everyone is used to the startup environment that, you know, someone like yourself, it's very comfortable in. Like, if somebody wants to do something, you do it, right? You Nobody told you to start a podcast. So, um, trying to rewire everyone's way of thoughts into doing things, not because they were done the way, you know, the mortgage industry has done things very similar among very different companies for many years. Like, that doesn't mean that we have to continue doing things that way. So, we've had a lot of good people, but sometimes it takes, a few weeks to a few months for um, a team member to realize, hey, the if I do a good job, that's all that matters, and I can do that any way I want, as long as I hold the company's name in a good light, and uh, like I said, uphold good lending and treat our customers and investors right. But but it's interesting to think about, because I was a very different person myself when I was at Jeffries or uh, Amherst Pierpont. I was much less likely to do something unless I was told to by my boss or my manager. So that's definitely
Just
been.
actually,
Sorry.
yeah, I was just having a conversation about this the yesterday with a friend of mine, and he's an entrepreneur as well. And we're talking about there is divergent and convergent thinking. So convergent thinking is what we're taught in school, which is converge upon an answer. There's a right way of doing the math. There's a right way of getting the answer. The answer is correct or incorrect. That you show your work, right? You're supposed to do it in certain steps. Same thing with a paper, right? There's a right way to construct a 5-paragraph essay paper. And so a lot of our lives were taught, school in particular, but even early stage jobs or corporate jobs are typically, at least on the lower levels as you're getting started, there's a right way and there's a wrong way. I converge upon the answer. Do it this way. This is the process. This is the step. This is how you should do it. This is how you should not do it. And so we're kind of inculcated with that for most of our lives. But then as you start going deeper and deeper in the workforce, and entrepreneurship is probably the extreme degree of it, you find that the rewards relate to, and I think you just said it, getting it done, right? Figuring out how to get it done or getting the result. And it doesn't really matter the specific way in which you get it. Obviously, you want to make sure you're doing it legally and,
Of course.
ethically. But besides those things, if you have a different, unique approach or you come up with a creative solution, that's actually more rewarded than necessarily following the old Byzantine rules that no one really understands why you do them. And so, and
Not as
that's
much so,
divergent
though,
thinking,
in
right?
the
Kind of
corporate world, though, I would say. It's not
right.
not
And that's the
necessarily.
interesting piece about it. Is like the corporate world is far more structured and rigid in that. And to kind of like bring it home, since you've been able to kind of do that swap and do that flip, the the difference between corporates and scale often feel diametrically opposed from innovation and kind of
Yeah.
agility. Do you think that there's something that corporations, I mean, you having worked in them many times ever, do you think that they can bring these aspects, or do you think it's just fundamentally different schools of philosophy and they can't be married together, and small companies innovate and big companies scale?
I mean, I may not be the best person to answer this question, but, you know, a lot of companies focus on this, right? Like, they start corporate venture capitalists, corporate VC funds, uh, and they've had varying levels of success. Um, I'm not sure if you're familiar with this one, but I thought an interesting, I would say, like, case study or successful company that did this was Goldman Sachs, with Marcus, and this is in my industry, which is why I know it so well. But it was wild how much they decided to start with a blank piece of paper when building that brand. Um, Instead of having cubicles, I think every room had whiteboards on it. Um, the dress code was significantly different from the rest of the bank. Uh, the structure was extremely different. Um, and although they've had varying level of success, it's hard to understand if it's macro or what they did there. But it's I will say this, especially in the financial industry, the stakes are so high from a regulatory perspective and a risk perspective and a front page of the journal and you know looking terrible in front of the rest of America, that those protocols and compliance uh, functions are in place for a reason. Because if there is an issue, whether it's a bad actor or someone negligently missing something, because we're talking about wires and large money markets, the risk is significant. So there is something to be said about a company that is segregated from a large institution like Goldman or Bank of America. You know, Wells Fargo was in very hot water for some of the things that were going on there, you know, where you can take the risk and try to scale quickly. But um, you know, like I said, I'm probably not the best person to answer that question because uh, it is a very difficult thing to pull off. Historically, it seems.
So, as a fintech innovator, I mean, you are literally in this space, you're in the mortgage space, you are building new products and new ways of creating mortgages. You mentioned that one of the big things that your team has to focus on is compliance and regulation and making
Yeah.
sure you don't make mistakes. How much does that hamper your ability to innovate, grow, and be agile and scale quickly?
Um, it really limits your ability to say, "This is what I want to do. I'm going to go do that." All right. Um, there are both large amounts of rules and regulations in place that are required, as well as a larger knowledge set that you need to personally become comfortable with in order to try to be innovative. So there are possibilities for innovation and speeding up the process and improving lending, both at a risk and a user experience level. But I think there is a requirement for you to understand the laws of what you're getting into before you start making those changes. But a simple example was, I think I mentioned, I want to give lower cost options than a credit card or an unsecured consumer loan. So I want to be somebody's looking to get $50,000 from an unsecured consumer lender. They get a 13% rate. I'd want them to come to me at, you know, 8, 9, 10%. With me, they have to wait 3 days before they can get their money. That is just the law. It's, you know this from your experience in mortgage lending. It is there's nothing you can do about that. So it's really hard to compete with somebody who can, within 12 hours get a check in their bank account or a deposit in their bank account. Um, there's also a lot of, uh, I would say, we've had investors or due diligence firms that have said, "Hey, why are you not having these documents signed?" And simple things like so it's on the record, a 1003, we didn't have third party brokers sign. Um, there's no legal requirement for that. However, there's an expectation from Wall Street that these be signed. So we had 50, 100 mortgages that we needed to sell, and we had to convince, a third party vendor that these loans are fully compliant. So it takes some time, and it takes, like I said, knowledge of the law in order to make your case. Um, but a friend of mine, I think I actually introduced you to him, Austin Lane. He's a founder of Notable Fi. They are a lender. He's had a lot more startup experience than I have in his career. He always says that starting a fintech startup is kind of like starting a startup in hard mode. It's just the burdens of accuracy and regulation is so much higher. You know, if your Bank of America account is off by $1, you are going to notice it. But if your Instagram likes are off by 5, it's nobody ever notices it. So there's definitely um, a much harsher penalty for you know the growing pains that startups typically go through.
Do you think that moat is helpful because it helps you if you are able to live up to that standard, then you have a unique advantage against others who may play in the fintech space and then don't have that level? Or do you think it's, you know, negative for the industry and you because it just hamstrings you from day one, and you have to put X amount of resources towards just keeping up with the compliance and regulatory aspects. Whereas what you really want to do is truly innovate and do a little bit of, I want to do this, so I'm going to go do it,
It's a good
which you
question.
just can't do.
It's a pain in the ass, but I've leaned into it and liked it. Um, One of the nuances of this market is a lot of the regulations that were written were not prepared for interest rates where they are right now. So, like, the software vendors are not ready for this. Like, we've, you know, the home equity market now is lending at anywhere between 9% to 14%. We're triggering all these new regulations that haven't been discussed in, 20 years. Um, so everybody, including myself, shut down lending in Texas. Um, when interest rates went above 10%. And this is APR, so that includes everything. We were one of the first lenders to open that up. I personally spent a lot of time understanding the Texas laws, read through them, had many conversations with lawyers who specialize in Texas laws, and it helped us. Like, if somebody wanted a loan in Texas that's a second lien, they could either go to a federal bank or they could come to us. So I definitely leaned into it, tried to understand um, all the laws and regulations, whether reading them myself or maybe reading summaries of them. But and I think this is also a result of what we went through during COVID, when there was no one else out there buying these loans. Um, what I had was time, so uh, we spent a lot. When I say building products, we really got into the nitty gritty of understanding the rules and regulations of what we were getting into. So yeah, it's definitely created a moat. We had a 3-4 month lead in Texas, got some great customers, and we do a lot of business in there. Um, we are also the reason why some of the biggest lenders in the country are lending in Texas, um, because the loan buyers were also not comfortable with Texas until Button Finance explained it to them. So it's a riskier loan to make, and if you're going to get caught with a loan, it's going to be a Texas loan. Um, just an aside, Texas had in their constitution, home equity loans are not allowable in the state, so they had to amend their constitution to allow us to do business in there. This happened in the 90s, but it's the result of that has been a very difficult to wade through legal environment. So to answer your question, it's been something we've leaned into here at Button.
That's interesting. I'd never even thought about requirements that are based on certain interest rate triggers, and hitting that inflection point, the entire underwriting decision and process and purchasing in secondary market just completely changes based on that. What you know, looking at that, looking at kind of the changes we've had in the past 18 months, call it, in the mortgage market and just the interest rate environments in general, and then looking into Jason Harris's crystal ball of projections and what you think we're heading towards. Any insights for maybe the mortgage world or just the finance world in general for what end consumers can expect?
So I will avoid making any sort of macro predictions. Um, I will say I don't think we're going to get back to 2%, 3% again. Um, and it's wild how used to free money that we did get. But when it comes to the lending environment, it's very hard to make predictions because so much of it hinges upon the regulatory environment. And, you have, uh, I'm not partisan in any way, but you had the CFPB, Consumer Financial Protection Bureau, created as a result of the financial crisis to protect borrowers. Then you have a Republican president come in, Trump, and decide that he wants to limit the power significantly. Um, Fired the CEO. I think the guy couldn't, they locked him out of his office. So whether or not the laws are uh, both amended to allow for lending at higher interest rates, which again would have been blasphemy to make a mortgage at 12, 13% 2 years ago, now is, in line with the rest of the market. is both a result of what the statutes are as well as the regulatory environment as to what laws they enforce. So it's really hard to say which way we're going to swing. But I will say that in my experience, you know, large money managers will find ways to put their money to work in the most effective way that they deem in their judgment. So if there is a good risk return on a loan and it's scalable to make these loans many times, that is something that I expect to continue uh, to move forward. But like I said, to answer to your question, I've like to refrain from making macro um, forecasts just because they're typically wrong. And um, what we've seen over the last few years may be unprecedented in our recent memory. It's small potatoes to some of the sell-offs that we had in the 80s, um, and even earlier than that. Where rates, I think my parents refinanced from like a 14% to an 8% in like a 12-month period. So that being said, it is definitely a consideration when interest rates get high for borrowers to make sure that they are comfortable with the debt burden. And as you know, again, with your history in the mortgage world, um, ability to repay is something that we take very seriously. And I would also say that you know, although I wasn't a lender, I've traded many pre-crisis mortgages during my career. Um, I think borrowers are much more informed given the foreclosure epidemic we had post 2007 and all the delinquencies we had and people living in homes that were underwater. I think there's a lot more regulation on the lending front as well as a lot more you know conservatism on the borrower front.
Yeah, I mean, one of the things I've been talking about with my friends, given I have the mortgage tech startup background as well, and still have a lot of those ties, is a lot of the debt that we're looking at is actually really good debt. There are a lot of good loans out there, whether it's non-QM loans or even HELOCs or primaries. It's all good debt. I guess conventional conforming is typically pretty standard and cookie cutter, and that hasn't changed too much, even if the rates have changed. But a lot of the desire for different kind of out of the box mortgage products has just completely dropped off because the secondaries investors don't want to buy something that's perceived as riskier. What do you think it is about the mortgage world, the finance world, the secondary world where yes, I understand that liquidity is king right now and people want to be conservative and run a little bit scared, but the loans that are being created, the quality of them today is probably the highest it's ever been. And it's definitely nothing like, 2008, 2007 loans, 2006 loans. Like the quality of the credit profile, the amount of data that is going in these loans is astronomically high. The returns are fantastic. And yet people are still holding off from really leaning back into buying on the secondary side. Like what is driving that fear?
So, I mean, when we started Button Finance, I went to the MBA conference in Austin, Texas at the end of 2019. It was early 2020, forget it. And I said, I want to start a second lien lender. And people looked at me like I had 10 heads. They were just like, but what if they default? And I'm like, well, then we take a loss and hopefully we recover some of the money. Uh, but it's definitely changed. People, investors are much more comfortable taking risks. That people are buying home equity loans today. Um, but it is vastly different than the market we had pre-crisis, pre 2008. Um, I mentioned I was trading mortgages, and I was more junior at that time in my career. I would often do very deep research into a single bond, and some of these bonds, it was like a 20 loan bond, large loan balance, let's say $1 million a loan, and it was like John Smith, Jane Smith, Elijah Smith. The dog would have it would be like 5 mortgages on the same zip code from the same borrower. Um, like the Wild West. Like there was absolutely, and they were all also packaged in the same bond, which was just wild. Um, Clearly, there was a culture of get as much leverage as you can and buy as much property as you can, um, and home prices will bail us out. That that no longer is the case. Um, like I mentioned before, ability to repay. Uh, One of the resulting legislations or regulations after the financial crisis is, uh, as a lender, you have to verify a borrower's ability to repay. Um, there are a number of ways to do that. Some of them give you safe harbor where you
What a
can,
novel concept, by the way.
yeah. Well, I mean, the alternative theory would be laissez-faire, buyer beware, but um, not here to discuss, you know, theories there. But if a borrower, right, because as a lender, you can't lend unless you're willing to take a risk, right? So you just have to be able to say how much of a probability will I assign to taking a loss here, and then what's the interest rate that needs to compensate me in order to take that risk. Um, that is not allowed as a mortgage lender. You can definitely do that, but you still have to verify the borrower can repay, the borrower has the funds, the borrower has the sophistication. So that is a result. And then lastly, I'll say, which I don't think is seen as much, at the or written about as much. Um, like a lot of money, like I said, comes from banks, which have less regulations and they can do more with what they want. But there's a lot of money in uh, endowments, mutual funds, hedge funds, and a result of the crisis we've seen, like let's take a hedge fund. Hedge funds have limited partners. LP agreements now disallow certain type of risk taking that previously would have been allowed pre-crisis, specifically in the mortgage world. So there's specific like mortgages that are just not allowed to be bought, um, not allowed to be securitized. So, like I said, personally, I've done very deep dives into the laws. Um, and there are some mortgages that I think we should be comfortable making because they are uh, both good from an ability to repay, good from an investment perspective, but nobody will buy that mortgage because if you want to put that mortgage into a bond, it's 3 months from now, you cannot put a mortgage into a bond if it's quote unquote high cost, for instance. So there is that's just the third factor I would say. Like the contracts that have been standardized, whether it's used for an LP agreement, a money manager, family office investment, or simply a securitization, they're not getting rewritten, and there are clauses in there that just disallow certain mortgages to be made.
Yeah, it's interesting to see how the regulation really does shape the landscape of where you can innovate and what you can do. And with an ever changing governing body, the government, the laws change, the leaders change. And so there's a certain amount of, if you're in the fintech space, yes, or any kind of compliance and heavily modified. I think finance is probably the most mercurial in terms of
Yeah.
it shifts with the tides. But if you're in a compliant and regulated industry as a startup, yes, there's a certain amount of, we have a thesis. This is what we think the gap in the market is. This is the product that we're building to address that gap. But then there's the reality too of, well, regulation might change in 2 years and we're just going to have to adapt and we're going to have to figure that out.
Yeah. Um, and one of the things we spend extra time on, like I mentioned, we make sure we're underwriting loans accurately, we're treating borrowers well. Um, there is also something to be said that you go above and beyond and make sure that nothing you're doing has any sort of disparate impact where you're affecting certain minorities differently than uh, other groups of people. Um, because if you were to be making a clerical error consistently across 100 loans, but it's not treating certain geographies differently than other geographies or races or classes, that the ramifications are much more manageable from an ethical perspective as well as from a regulator perspective. So we take an extra, you know, we have extra protocols to just make sure that we are not aware of certain things when it comes to decision making, such as race or um, geography, zip codes. As a lender, we obviously know the geography, but we don't uh, we don't take any sort of subjective view on it. We only use data from vendors to determine the risk of said geography.
To close this out here, what would you give as advice to someone who is in the finance world or finance adjacent and has identified that there is a gap, there is some arbitrage play or some ability to kind of build a unique product, build a startup around a specific problem set, and I think that there's that gap in that area for innovation. What advice would you give to a fintech entrepreneur starting today?
I would say put a lot of time and priority to building your Rolodex, because you just mentioned, there's a gap, there's an arbitrage available. Having an arbitrage available is not necessarily enough to get an investor to pull the trigger when it comes to putting capital at risk because, from an investor's perspective, they have a job. If they lose money, they don't have a job. If they, hit a home run, they may not make that much more money. So you really have to make sure that um, your partners, whether it's investors or clients, are comfortable with you as an individual, can be willing to think outside of the box and not just, as I said, uh, go look at the contract and say, I can't do this because it's something that we've been previously burned on. Or so having a good network, um, what and it's whether it's using your network for referrals, but it's very important to understand the players because convincing large money managers to do something that they haven't done before is a very difficult thing to do, even if it's the greatest trade since sliced bread. Similar to one of the startups I invested in is in the medical industry. Becoming a vendor for a large hospital is very difficult. It's a very long sale time because from the hospital's perspective, you could have an amazing product that makes life easier, but if something goes wrong and they can't use it, more, the downside is so large that you really have to spend time, get to know people, have them become comfortable with you, believe in your thesis. Does that answer your question? Because I may went a
It
different way than
does.
you were
It
expecting
does.
there.
No, I mean, I think that there's a lot to be said of the idea alone, the gap in the market alone doesn't necessarily mean you should jump on it. And I think particularly with the finance world, I like how you made it very clear. Like tremendous upside doesn't necessarily lead to tremendous upside for the individual that's making the buying decision. And a little bit of downside equates to massive risk for the,
Yep.
the buyer, the client, the investor. And I think that maybe it's not to scare away, but it's to paint a realistic picture of if you're going in, having those relationships, having that network, having those connections, and also having strong confidence in yes, this is a
It's not necessarily a
valuable problem to
prerequisite.
solve. But
I'm just saying it's something you should
correct,
work on. It's important
yes,
to try to know people who can give you feedback too, because you may learn something, right? Like that you may learn if you change this slightly, I'm all in. And
yep.
everyone else that feels the same way because we're all similar actors. But yeah, did not mean to interrupt you. I just wanted to make clear, like I'm not saying you have to have a strong Rolodex. I'm saying spend time on it and get to know people.
Yeah, and I think that's just generally sound advice. Is the idea alone is going to get you so far, and you can get there with willpower and by dint of effort, and you can do it without a network. However, having that network will only help, and having those relationships will only help, and doing a little bit more due diligence and product market research and figuring out if I make this, will you buy it? Is this helpful?
Yeah.
Or if I shift it this way, will that be helpful? Is always sound starting advice.
Funnily enough, I think I obviously know it's important to have a good network, but I think I really took that advice to heart from a podcast. It was a 20-minute VC with I think the guest was Andy Ratcliffe, the CEO of Wealthfront, as well as his VC himself historically, and you know he just emphasized like having that asset in your back pocket can really help you navigate um, this type of market where you can't just sit in a dorm room and create a piece of technology. You really have to have, whether it's investors or uh, you know regulators. We're not at that size yet, but these big companies, they have to be in front of the regulators, know them, in order to make sure that everything they're doing is acceptable. But like I said, hard mode for fintech startups is uh, a lot of moving parts. But like you pointed out, it's an opportunity for a mode as well.
Absolutely. Jason, if people want to find out more about Button, get a HELOC, or follow you in your journey, where should they go?
Buttonfinance.com, and I'm sure I'll repost this to LinkedIn as well.
Perfect. Thanks for coming on.
Thank you so much, Elijah. It's been great catching up with you.
You as well.
All right.
To be continued.
Bye-bye.
Bye.